Welcome back. In this video, we're going to talk about leverage and risk management, what they actually are, and how they can affect your trading. A lot of traders first meet leverage through marketing banners and big numbers, 20x, 50x, 100x, and it sounds like free money. But in reality, leverage is just a high risk tool. It can accelerate your returns if you already have an edge, or it can blow up your account very quickly if you don't. What we're going to do here is strip away the hype and look at how it really works, using a live strategy example from Arrow Algo to show you the impact. Let's start with the basics. Leverage simply means you're borrowing extra buying power from the exchange so you can control a bigger position than the cash you actually put in. The part you put in yourself is called the margin. Imagine you have $1,000 in your account, but you only want to risk 10% of your account on this trade. You open a 20 times leverage position, so you put up $100 of your own capital as the margin, and you make sure it's an isolated margin so that this $100 is all that's at risk. That $100 is the collateral, and with 20 times leverage, that single trade now controls a $2,000 position. The exchange is effectively lending you the missing $1,900, and if the price goes up by 1%, you've made $20 on a $100 margin, which is a 20% gain on the trade. But if the price goes down 1%, you lose 20%. You can see the pattern. Leverage doesn't change whether the trade is right or wrong, it just multiplies the outcome. Now the big risk is liquidation. Remember, your margin is the buffer covering your losses. If the price moves far enough against you that your margin can't cover the losses, the exchange will step in and close out the position and you'll lose everything. The exchange doesn't wait for your entire margin to hit zero, it will close you out a little bit before that point to cover the fees and the slippage. In the crypto market especially, 5% moves can happen in minutes, not weeks. This is why so many new traders get burned quickly using leverage. They go in without a plan and they get wiped out very quickly. So how can we use leverage in a more structured way? Let's walk through a real example using Arrow Algo. I've built a very simple long strategy on Solana USDT. The idea is straightforward. I want to catch short-term dips in a broader uptrend. So I buy when the 4-hour MACD shows an uptrend and the 5-minute RSI drops below 30. That's my dip buying condition. I close when the RSI goes above 75. It's not meant to be a perfect system, it's just something that we can work with here to experiment with. So first I'm going to run this strategy with spot trades, trading 100% of the account with no leverage. Over 6 months in a bullish period, this strategy returned around 10%. The win rate's in the high 60s, and the average gains and losses are a few percent each. Nothing spectacular, but clearly there's a little bit of edge. Then I take the exact same logic and run it with 10 times leverage. I'm going to trade 10% of the value of the account with each trade. Let's run that backtest. The total net return is still in the 10% range, and the win rate's pretty similar. But if you look under the hood at the statistics, you can see what the leverage has really done. The average winning trade is now in the low 20s instead of just 2% before, and the losing trades are much sharper as well. There are trades dropping 40% or more on the margin. In the trade list, you can see at least one liquidation, a full minus 100%. If I crank this up to 20 times leverage with the same parameters, the total return increases to around 20+%, and the average win is now in the high 40s. But the average loss is massive as well, over 70%, and again there are clearly some liquidations. Remember, we're risking 10% of the account per trade, so 2 or 3 liquidations back to back would be enough to wreck the entire portfolio, even though the backtest still shows a positive headline return. This is the reality of high leverage. It doesn't necessarily create an edge, it just amplifies everything, including design flaws in your strategy or holes in your risk management. So what do we do about it? Well, in this case, I'm going to add some protection. In this example, I've made 3 changes. First, I've added a volume filter to the entry. I only want to buy when the short-term volume is actually picking up. So on the 5-minute chart, I check that the 3-candle volume moving average is above the 10-candle moving average. If there's no real volume behind the move, then we'll skip it. Second, I've added a hard stop loss using the last profit block. Instead of waiting to be liquidated, I'm going to tell the strategy to close if we get close. I've got this one set to 70%, which sounds like a lot, but at 20 times leverage, a 3 to 4% move against us can already be in that range. This rule lets the trade breathe a bit, but cuts out the absolute worst cases. Third, I've added a trend reversal exit. If the 4-hour MACD flips bearish, the strategy closes the position even if we haven't hit the RSI exit or the hard stop. There's no point holding a leverage long if the higher time frame trend is turning bearish. When I rerun the backtest over the same 6-month window with these extra rules, the difference is huge. That same leverage strategy that was making around 24% before is now up close to 190% in the same market. The win rate stays in the mid to low 60s, the average win is around 47%, and the average loss is significantly reduced compared to the original leverage version. The largest drawdowns are still pretty big, this is leverage trading after all, but the equity curve is much smoother and all the liquidations have been largely removed. Remember that leverage doesn't fix a bad strategy. It's a tool that sits on top of your edge and your risk management. Your job when designing strategies is to decide how much risk you're willing to take and how to protect yourself from liquidations and large drawdowns. Remember, this is gambling. Never risk more than you can afford to lose, and make sure you backtest your strategy in a range of market conditions so you can get a good idea of how it's going to perform. In the next video, we're going to take a look at the types of margin you can use. I'll see you there.